welcome back to Economic Insights. I'm Alex, and as always, I'm joined by Selim, market veteran, show producer, and someone who's seen a lot of wild market weeks. But Selim, I have to say, this week might be up there with the wildest.
When geopolitical events dominate to the point where we need a separate section before even discussing employment data, you know it's been an exceptional week. We're talking about a US military extraction of a head of state, open conflict between Saudi Arabia and the UAE, and protests across Iran, all in the same 7 days. You can't exactly lead with the ISM services data, can you?
No, you really can't. So we're leading with geopolitics.
We have to. The market implications are too significant to bury in the usual format.
Let's dive in then. Venezuela. What exactly happened?
Over the weekend, US forces conducted what's being described as a surgical operation. They captured Venezuelan President Nicolas Maduro and his wife, extracted them from the country. The Trump administration wasted no time, immediately announced it intends to control Venezuelan oil sales indefinitely, and has already seized oil tankers linked to Venezuela in the Atlantic and Caribbean.
Is this regime change?
It's a selective regime change. They decapitated the leadership, but left the broader regime structure intact. The analysts are saying the US goal is controlling oil and countering foreign influence, Chinese, Cuban, Iranian, rather than rebuilding Venezuela. There was even a threat of a second wave with ground troops if the interim government doesn't expel foreign agents, but Donald Trump gracefully called it off.
How did the markets respond?
Venezuelan bonds surged about 25% on expectations of a friendly debt restructuring. Oil had a volatile day, initially dropped on hopes that US investment would restore Venezuelan production capacity, but then stabilized when reality set in about how expensive and slow that process would be. Equity markets globally barely blinked.
Is this different from how Russia operates?
The contrast is striking. Putin's been prosecuting his war in Ukraine for years now. Massive troop deployments, enormous casualties on both sides, international sanctions isolating Russia economically, and he's still grinding through Donetsk. Compare that to the US operation. Fly into Caracas, extract Maduro without resistance, seize control of oil exports, announce indefinite oversight. Mission accomplished in a weekend. Venezuela's military had no appetite to defend Maduro, which Putin can't say about Ukrainian resistance. I'm not sure there is a Nobel Prize for efficiency, though, much less a peace prize for military operations.
What else blew up geopolitically?
The Middle East got significantly hotter. Saudi Arabia bombed a UAE-linked weapons shipment in Yemen intended for separatist forces. Riyadh publicly accused the UAE of highly dangerous behavior threatening Saudi security. Then the UAE facilitated the extraction of the separatist leader from Aden. The Saudi-UAE rift has gone from cold to hot.
Iran's dealing with domestic unrest?
Widespread protests sparked by the rial's collapse and economic damage from what they're calling the 12-day war with Israel. Trump issued a warning that the US is locked and loaded if the regime uses lethal force against protesters. Meanwhile, UK, France, and Germany activated snapback UN sanctions. The pressure on Tehran is mounting from multiple directions.
And Ukraine's situation?
Continues to deteriorate for Kyiv. The Kremlin rejected any proposals for European peacekeeping forces, explicitly warning that Western troops in Ukraine would be considered legitimate military targets. Russian forces are making confirmed advances.
With all this chaos, markets hit new highs?
S&P 500 and Nasdaq 100 both reached record highs by Friday. The market interpretation seems to be that US military dominance in its own hemisphere is bullish for American interests, and the Middle East conflicts are contained regional issues.
Okay, beyond the geopolitical drama, what happened with the actual economic data?
We had policy-induced volatility midweek. Trump targeted specific sectors via social media, announced plans to ban large institutional investors from buying single-family homes, which crushed real estate stocks. Then he demanded defense companies halt dividends and buybacks, sending defense stocks down sharply. They recovered partially after the administration floated a $1.5 trillion defense budget proposal.
That's a lot of whiplash for investors.
Age of policy by tweets. On the data front, We got divergent signals. Early week, the ISM manufacturing print was weak, which sparked hopes for Fed rate cuts and drove a bond rally. But midweek, ISM services hit a 14-month high, suggesting robust economic momentum. That pushed Treasury yields higher as markets repriced Fed expectations in a hawkish direction.
The main event was Friday's employment report. How should we interpret it?
December non-farm payrolls increased by 50,000, below consensus. Private payrolls contributed only 37,000. However, the unemployment rate dropped to 4.4% from a downwardly revised 4.5%. Average hourly earnings rose 0.3% month on month, translating to 3.8% year on year growth. Markets called it mediocre, not weak enough to force the Fed's hand on cuts, not strong enough to rule them out entirely.
What about those benchmark revisions we keep hearing about?
They're expected to lower the trailing job gains by over 70,000 per month, which means the labor market has been cooling more than the headline numbers suggested. But you've also got emerging slack indicators. Involuntary part time work is rising, and the hiring rate has declined to levels we saw in 2013 and 2014. Mixed signals give the Fed cover to wait.
There was a major housing market intervention too.
Significant. The administration directed Fannie Mae and Freddie Mac to purchase $200 billion in mortgage bonds to lower rates. Mortgage spreads tightened immediately. It's direct market intervention on a massive scale. The political motivation is obvious with elections ahead.
What's the Fed thinking right now?
They're firmly in wait and see mode. The benchmark payroll revisions suggest the labor market cooled more than we knew, but core PCE inflation is still running at 2.8% year on year as of November. That strong ISM services print doesn't help the case for cuts either. There's simply no urgency.
So January's meeting is a hold?
Consensus is solid on a hold for the January 28th meeting. Beyond that, it's entirely data dependent. The bias has shifted slightly more hawkish after this week's services data and sticky wage numbers. The Fed needs to see more convincing evidence of disinflation before moving.
Europe's in a different position.
Softer inflation readings support the case for European bonds. The ECB is in a more dovish stance than the Fed given weaker regional growth and inflation closer to target. Germany's fiscal expansion plans remain a wild card. If they materialize, they could provide a meaningful growth impulse. But political frictions around pension reform create execution risk.
Japan's still normalizing policy?
Gradually, yes. The BOJ continues moving away from ultra accommodative policy as inflation stays above target. The yen's trajectory is interesting. It should appreciate as rate differentials with the US narrow, but market positioning and intervention risks mean it won't be a straight line higher.
Let's talk FX and commodities. What's happening with the dollar?
Consensus outlook is bearish, though the degree varies. Some expect a shallower descent compared to past cycles. Others are more aggressive. The fundamental story is that US economic exceptionalism is fading. Growth differentials are narrowing globally. Analysts point out that relative equity momentum has shifted, with the US actually lagging global equity returns recently. Several potential catalysts accelerate the decline. A derating of US tech dominance. Imagine another DeepSeek moment where AI leadership gets questioned. Rising concerns about Federal Reserve independence could weigh heavily, and there's a structural shift happening in terms of trade, favoring metal exporters over oil exporters, which is structurally dollar negative.
The euro's benefiting from German fiscal stimulus?
That's the key support. German fiscal spending is expected to deliver a cyclical upswing, and market based measures of German fiscal activity are already outperforming broader indices. The euro also benefits from its positive correlation with global risk sentiment. The asymmetry is compelling, downside is capped unless the Fed hikes, but upside is significant if US data softens.
Japanese yen, I know views are all over the place.
Wildly divergent. One major bank forecasts JPY around 139 in 12 months based on deep undervaluation. Another expects 164 by year end, projecting continued yen weakness. The bearish case argues that BOJ rate hikes and interventions are losing effectiveness as global easing cycles wind down, and domestic political opposition to hikes strengthens.
Emerging market currencies generally?
The Chinese yuan stands out, expected to appreciate to 6.85 by year end. It's characterized as deeply undervalued, with robust export growth and increased central bank tolerance for strength providing support. Corporate dollar selling is helping too.
Oil markets must be reacting to Venezuela.
They are, but the trajectory is bearish. Forecasts show WTI crude declining to the low 50s by Q4 2026, with Brent following suit. The Venezuela regime change is a long term supply story. Analysts project production increasing from zero point 0.8 million barrels per day currently to 2.5 million over the next decade. That's a massive addition to global supply and puts downward pressure on prices.
Canadian producers must be worried.
Absolutely. Increased Venezuelan heavy crude production directly competes for US market share, hurting Canada's terms of trade. It's one factor behind the bearish Canadian dollar outlook. USD CAD targeted at 1.42 by year end.
What's happening with precious metals?
Timing is significant here. The Bloomberg Commodity Index rebalancing is happening January 9th to 15th. Gold faces estimated selling pressure of almost $6.0 billion worth. Silver's getting hit harder proportionally with $6.1 billion in sales, representing about 10% of aggregate open interest. That's the largest relative selling impulse across all commodities. The flows are rotating into cocoa, crude oil, natural gas, and gas oil.
That's a major technical factor.
Exactly. Meanwhile, copper's cautious near term. Prices are high at around $13,000 per metric ton, and Chinese fundamentals are soft. Nickel is rebasing ahead of Indonesian supply changes. The base metals outlook really hinges on whether Chinese stimulus materializes in meaningful ways.
China. Let's start there since it drives so much of the emerging market story.
China's doubling down on what analysts call the muscular manufacturing model. Trade surplus has exceeded $1 trillion, and export volume growth is expected to stay in the high single digits. But the domestic picture is still weak. The housing market continues struggling with negative equity and slow price declines. Consumer spending remains subdued due to a soft labor market and fading impact from government trade and incentives.
What's Beijing's policy response?
They're launching the 15th five-year plan focused on manufacturing and exports. Expect one or two rate cuts in 2026 and a slightly widened fiscal deficit. Interestingly, both the CNY and other regional currencies like the Taiwan's dollar and Korean won are projected to strengthen against the dollar this year, which is noteworthy given typical EM currency patterns.
India seems to be the growth star.
India remains robust. Growth projections are anywhere between 6.5% to 7.2%. There's a policy pivot happening from public investment toward private consumption, supported by income tax cuts and GST rationalization.
How's inflation tracking there?
Divergent forecasts. CPI inflation is expected to moderate to a record low of 2.0% in fiscal 2026 before normalizing above 4%, while still hovering near the RBI's 4% target. Food inflation is expected to mean revert higher, which pushes headline CPI forecasts up. Inflation dynamics give the RBI room to stay patient.
Taiwan and Korea both benefiting from the AI boom?
Absolutely, though Taiwan's getting the bigger boost. GDP forecast at 4.4% for 2026 versus Korea's more modest gains, driven by Taiwan's dominance in compute and foundry services. But both face headwinds: sluggish domestic demand, elevated household debt, and shrinking working age populations. The Bank of Korea is maintaining its policy rate at 2.50% at the upcoming January meeting, prioritizing currency stability and financial system concerns over growth support.
Latin America's obviously dominated by the Venezuela story.
Venezuelan bonds rallied 25% on the regime change and expectations of US directed restructuring. US licenses will redirect oil sales to American buyers, prioritizing economic recovery and oil sector development over democratic elections in the near term. Brazil's central bank is forecast to cut rates to 11.5%, diverging from regional trends. The real benefits from carry despite ongoing fiscal concerns. Mexico's central bank is expected to cut to 6.0% by year end.
Turkey's inflation picture just got more complicated with that wage hike.
Significantly more complicated. December inflation came in at 30.9% year on year, with consumer prices up just 0.9% month on month, softer than expected. But then the government's announcement of a 27% minimum wage increase was well above the range analysts expected. This creates both cost push pressures from higher labor costs and demand pull pressures from increased purchasing power. January brings more pain. Administrative price increases on medical copayments and increased taxes on fuel, alcohol, and tobacco all point to a monthly headline: inflation could jump 3 to 4% in January.
How's the central bank responding?
Expectations for January converged on 125 to 150 basis points of cuts, down from earlier forecasts of up to 250 basis points. The central bank's 16% year end target looks increasingly unrealistic. Forecasts now project 20 to 23% by year end. Policy rates are expected to end 2026 somewhere between 25.5% and 28%.
Those are still extraordinarily high rates.
They are, but here's what matters for traders. With devaluation running around 15% and the overnight swap implied rate at 30%, the carry trade remains extremely attractive. That's providing support for the lira despite the challenging inflation dynamics.
South Africa's picture looks more stable.
The SARB is expected to cut 25 basis points in January, supported by low oil prices and benign inflation. Strategists are overweight on both the rand and government bonds.
What's Egypt's situation?
The IMF program is back on track, but it's conditional. They need to deliver on tax reform and asset sales. Investment strategies are focused on shorting USD EGP to capture carry. It's attractive carry, but there's real execution risk on the reform agenda.
Any overarching EM themes?
There's a near term tactical warning. Analysts see high risk of an EM correction over the next 1 to 2 months, given universal bullishness and crowded positioning. But the strategic view remains overweight EMFX and local rates, especially high yielders. EM bond funds saw their first annual inflows since 2021 last year, $31.8 billion. The forecast is for $40 to $50 billion more in 2026.
What's the key focus for next week?
Tuesday's December CPI report is critical. Forecasts are between 0.3 to 0.375 for headline and the core measures.
This matters for the Fed meeting at the end of the month?
Absolutely. Next week is the final data week before the January 28th FOMC meeting. The Fed enters its blackout period on Friday, so before then we'll hear from Bostic, Barkin, Williams, Musalem, and Jefferson. We expect to hold in January, and this CPI print will be crucial in shaping that decision.
What else should we watch?
Wednesday delivers PPI and retail sales data. Retail sales expected to rise 0.2 to 0.4%. We also get housing data including new and existing home sales, plus industrial production figures. China reports December trade balance on Wednesday, with export growth expected to slow.
Earnings season launches too?
Tuesday kicks it off with the major financials: JP Morgan Chase, Citigroup, Bank of America, Wells Fargo, Goldman Sachs, and BlackRock all reporting. The bar is getting higher for US equities.
Any central bank decisions?
National Bank of Poland meets Wednesday, Bank of Korea on Thursday. Both expected to hold rates steady at 4.00% and 2.50% respectively. UK releases monthly GDP on Thursday.
What a way to start the year. Thanks for tuning into our first episode of 2026. Remember, everyone, we do not give investment advice. For that, please consult a professional.
Indeed. See you next week.